Absolutely love the energy that I see here today. As Fitz mentioned, my name is Carl. I'm a partner at Six Man Ventures. We're an early stage crypto fund that was founded in 2021. Our main focus tends to be at the application layer. We've made over 100 investments in different companies across different crypto categories during that time. I have the unenviable position of being the last thing that separates you from food and drinks. So my promise is we're going to go through these 10 things succinctly, and then hopefully on your end we can have some good attention and good questions at the end of it. Sound good? All right. I love to start by just getting to know the audience a little bit. So everyone, put your hands up if you can. Yes, everyone. All right. If you are working full-time in crypto, I want you to keep your hand up. Everyone else put your hand down. Okay, as expected, most of the room still. If you are a founder or builder in crypto, keep your hand up. Everyone else, put your hand down. Wow, that's pretty good. That's actually a lot of founders and builders in the room. All right, lastly, if you are a founder or builder in the Monad ecosystem, keep your hand up. Everyone else, put your hand down. All right, look around. These are the people that are the VIPs of this event. It is you that are going to make Monad wildly successful. So congratulations, take that hand, give yourself a pat on the back. Very excited to be able to talk with everyone here today. All right, so this talk is titled Product and Company Building. As Fitz mentioned, I spent a number of years both as an engineer and as a product manager, and then after that went on to the investing side. And throughout that cumulative experience, there was a number of things that I learned, and I feel like I've been giving this advice to different teams or founders over the years, and I thought, you know what, I should consolidate this into one place. So this is my set of learned experiences. Hopefully it's helpful to everyone here. All right, if there's one thing that you take away from this entire presentation, it's that building enterprise value and building a company is more important than building the right product. There's the classic adage, first-time founders think about product, second-time founders think about distribution. After seeing hundreds of companies, some of them succeed, some of them not succeed, that is 100% true. So my hope is that by the end of this, you're focusing more of your time as a founder on creating enterprise value for yourself, your employees, and the ecosystem, rather than just building a good product. Okay? So what we're going to do is when we think about product, some of these things are very clear. Product definition. What is the product? What does it do? Who's going to use the product? Then we have things like product delivery. Okay, so once you got your requirements and you have your target customer, how do you actually take that product, increase the velocity of development speed, and actually deliver it to the market? Product includes things like growth and marketing. This growth can be product-led growth. It could be growth hacks in your product itself. It could be specific marketing channels that you as the founder or team are pursuing to go ahead and actually bring this product to the right customer with the right message. And of course, on the product side is pricing. Probably one of the least explored pieces that founders look at, but arguably one of the most important. And we'll talk more about this later, but pricing is a key piece of the product. Okay, so most founders spend, I'd say 70 to 80% of their time here, when in fact they should be spending most of their time on company building. So now let's talk about what that actually looks like and some different facets of it. Cash management is the most important thing for any founder. As seeing a lot of companies, the number one reason companies go out of business, as you can imagine, they run out of cash. Okay? So making sure as a founder you're conscious about cash, where it's stored, how much you have, your burn, incredibly important for you as a founder. Secondly is fundraising. We've seen companies succeed and companies fail based on their ability to communicate a compelling vision to the right set of investors that are going to enable them with the capital to succeed. Okay? So lots of time needs to be spent here. Brand awareness, not just marketing for your product, but when people think about a company, what do they think? What do they feel? Why, do people even know what your company is, or is it, oh, I've never heard of that before? Incredibly important, especially in this mimetic culture that we tend to have in crypto. Hiring, we're going to spend a whole slide here, but one of the most important things for the CEO of any company is to empower and bring on the right set of people to make that a success. I think we see a lot of times not enough focus on the hiring side. Vision we talked about, and lastly is M&A. There's a lot of teams that have a lot of capital that should be acquiring more teams than they do. And likewise, there's teams that probably should be pursuing acquisition but aren't. So thinking strategically about M&A is actually incredibly important in terms of creating enterprise value and building out your company. So again, at the end of the day, building great products is not the same as building a great business. Building a great business is harder, but more important to do than building a great product. Cool. So because of that, we're going to start with company building. So arguably the most important thing you can do as a founder is pick the right co-founder. And that question precipitates the next question, which is why do you need a co-founder at all? Well, in my experience, one of the things is building a business is one of the hardest, and actually in some cases one of the most irrational things you can do based on the amount of time and energy that goes into it relative to the likelihood of success. And the other part of being a founder that's less talked about is it can be incredibly lonely. If you have your employees, your team, you might have your friends from home, your friends from college, very few of them actually understand the challenges that you go through as a founder. And so having somebody there that is equally yoked, equally vested to you in the success massively can improve your morale and just help you to sustain throughout those dark periods that naturally exist in any company's life cycle. Secondly, of course, is complementary support. Okay? So how do you pick a right co-founder? Ideally, this is a hot take, that co-founder should be complementary to you, not an exact replica of you. I realize you might not be able to read every single one of these attributes, but here's some example founder attributes. Things like product sense, technical acumen, market analysis, community management. Nobody's going to be able to fill all the skill sets that are needed to be a successful founder. Nobody can do that. And so if you bring in somebody, let's say that's identical to you, where you both might have great technical acumen or great product sense, but if both of you are lacking on some of these other core functions, it just means as a team, it's going to take you longer to get up to speed than if you had somebody that already complemented you well. So what does that mean? Unless you're building a highly, highly technical product, having 2 Google engineers, as an example, come out and build a company may not be the best founding team compared to 1 technical person and 1 incredible person with business savvy. So beyond skill set, of course, personality. I'm part of a partnership. We have 3 other partners for total. For those of you who know Mike Dudas, he's an incredible personality. We are total opposites. But I think in terms of the way we make decisions, the way we approach founders, having somebody that's complementary actually makes us stronger as a partnership than if we had 4 Carl Vogels or 4 Mike Dudases making all the decisions. So incredibly important from that perspective. And then lastly, I'll just say network. If you're coming from a certain ecosystem, a certain part of the world, having a co-founder that has a completely different network vastly enhances your ability to succeed versus if all of you know all the same people, then when you need to grow, both of you are having to do a ton of hard legwork. So picking a co-founder, incredibly important. And the last things I'll just add here on this, as an investor, founder market fit is one of the most important things I look for early stage companies. And the reason for that is at the earliest stages, when you're just two people in a deck, there's very little to go on. We might have a talk, I have no idea who you are, but if you're building a DeFi protocol and you've worked at Wintermute, or if you've worked in traditional finance, or you've worked at a market maker, I know that you at least have the ability to understand the market and perhaps the technical capacity to build a high-performance trading solution than somebody that doesn't have those requisite backgrounds. So depending on where you want to go, where you want to build, if you yourself do not have deep founder market fit in that space, it doesn't mean you shouldn't pursue it, but it might mean it's helpful to bring somebody who does, because that way they can quickly understand the market and they're plugged into all the right networks. The other thing is finding somebody that is all in. And I'm going to use this term here, obsession, and it's a real term. If you are not obsessed with what you're building, you're probably not going to win. Because I guarantee you there's somebody else out there in the world that is obsessed and is focusing on it. So when you're identifying your co-founder, finding somebody who's equally obsessed with this problem space as you is incredibly important. When I see pitches, again, we see tons of pitches where it's, this person is, full-time here, but they're also full-time in this other community management role. It's almost an insta-pass when I just check out mid-meeting. Because for you to succeed, it's incredibly hard. And you have to find somebody that's all in. If they're not all in, you really need to have a hard conversation with your co-founder. Okay, Picking the right co-founder. What I'm gonna do is I'm gonna walk through the first 5, and then we're gonna pause for questions. So if you have a question, that's great. Just keep it in the back of your head, and we're gonna keep going. Secondly, if you are taking on venture capital dollars, you need to optimize for a massive financial outcome. Too often, we see good teams with good products, but a really effed up cap table that makes it very, very hard for other investors to later come in and actually support this company with the capital they need to succeed. Okay, so if you take venture capital dollars, you need to be thinking about a massive outcome. As a venture investor, every deal that I underwrite, especially if it's pre-seed, I have to see a path to 100x investment. If like a 10x investment is not an interesting outcome to me. So if you're partnering with an investor, really important you align on what's the type of outcome we're aiming for here together. So one of the ways that teams get themselves in trouble is they over-dilute too early in the business. So as an example, let's say you're doing your pre-seed round, you raise $2 million on $10 million valuation, great. You're up and running, you got 20% dilution, it's totally fine for the first round. But then if you raise, let's say a year and a half later, a round at 20 million, and let's say you raise another $4 million, well, at that point you have only raised $5 million of capital that you've diluted, excluding pro rata and stuff, 40% of the business. And 40% of the business is substantial. And so now, especially if you want to leave some of those space for community tokens, all of a sudden you have very little wiggle room left in being able to bring in that Series A large investor that wants to get meaningful ownership in your company. So the strong take here is if you dilute a lot in one round, you should not dilute, again, there's always exceptions, but you should not overly dilute in the next round. Because if you do, I can't tell you the number of teams I've talked to that do that, and they're like, oh, we want to have you guys come in and lead a Series A. And we're like, they're like, oh, our price is $150 million. And we're like, there's no way we're going to invest here. The company isn't worth that. They're like, we know, but it's the only way that we can get enough capital we need to succeed at 10% dilution. So don't over-dilute too early in the business. I cannot emphasize that enough. If you have questions, find me afterwards, and I can tell you more specific examples. However, the flip side of this is don't fret about a couple percentage points in valuation for the right partners that are going to enable you to succeed. And what I mean is, again, building a business is hard. Achieving $1 billion outcome is even harder, right? Like that, very, very few teams actually have done this successfully. And there's times where a team is raising, here's an example, let's say they did their seed round, $4 million at $20 million valuation, 20% dilution, cool, they're up and running, no problem. Let's say that they want to raise $10 million for a Series A. The company's doing well, they want to raise $10 million, okay? So let's say that they have one investor, a tier 1 investor, that say, hey, you know what, I'm going to mark this at 75, I can't really go higher. And then you have a tier 2 or a tier 3 investor, which we sometimes call dumb money, that says, hey, I'll come in and I'll do this at 100 million, I really want to win this deal. Okay. The thing is, a lot of times I recommend the founder take the lower valuation to get the right people around the table, because succeeding is so hard, you want to optimize for that chance of success. And on the back end of that, if you do succeed, the impact is not that material for you as a founder. So as an example, let's say you raise $100 million, or you raise your $10 million at 100 versus $10 million at 75, the team is going to get $700 million versus $666 million, about a 5% difference. Now again, $30 million is a lot of money, but on a percentage basis, that 5%, if you get $1 billion outcome, is not going to materially impact your life or your company, right? It's already game-changing money. You're at a totally different state of life. But as funds, especially like the tier 1 funds, we are evaluating our ability to deliver returns. And that difference in valuation can be a 25% difference for us on the return. So 5% for the founding team, 25% for us as investors. And so, again, I wouldn't worry too much about the valuation within reason if it allows you to get the best people possible at the table. Because again, you're trying to optimize for a massive financial outcome, not the difference of 5% on the backside of that. You'd much rather have 5% less and win than not be able to reach there because you don't have the right people at the table. Okay, so optimize for a massive financial outcome. Third is a very important slide. The goal of capital is to create enterprise value. Again, so you're raising money. You're like, oh, we're going to achieve certain milestones. The milestone that you should be aiming for is not to build a product. It's to deliver a set of enterprise value in different types of forms that then you can go ahead and raise additional capital that you need in order to succeed. So again, PMs think about products, CEOs think about enterprise value. So what is enterprise value? Well, there's a lot of different ways to value a business. Revenue is probably the most important and the most clear. If you have a company that's generating revenue, that's incredibly powerful. And your ability to demonstrate to investors, I have the ability to drive enterprise value and grow that over time. But sometimes we invest in companies that don't have any revenue, and that's fine. But there's other types of enterprise value that the team has created. It could be brand awareness. It could be that now when you think a particular crypto category, they're the number one thing that everyone talks about. Okay, well, if you're a category leader, even if you're not making much money, we understand that there's a pathway to revenue over time, and that is valuable enterprise value that a team has built. It could be data. It could be you have a proprietary set of data that you've accumulated across a wide number of customers, and we as investors are evaluating, okay, there's this data. I don't know exactly, they're not monetizing for it yet, but I know this data can be monetized in the future, and that's what I'm going to underwrite an investment towards. It could be partnerships. You're working with, for example, some tier one company in the space that's really valuable, or distribution channels. Another example, there's a team we were looking at, we ended up not investing for different reasons, but a team we were looking at that has exclusive distribution through Fireblocks. And we're like, okay, well, this team isn't making that much revenue now, but Fireblocks has hundreds of millions, if not billions, of AUM in their ecosystem and thousands of customers. And if they're the exclusive one that can distribute to this channel, we can immediately apply a percent conversion factor and say, great, this company's going to be in the revenue pretty quick. So again, don't think about the product when you think about the milestones that I'm going to hit. It's what enterprise value is somebody else going to underwrite this business at in the future. So again, to summarize, consider the enterprise value you need to create for your next round, and then back into the capital that you need to get there. Lastly, on this point, what I'll say is always raise with a margin of safety. Again, sometimes I chuckle when I see teams say we're going to raise a small amount to give us 6 months of runway. And I'm like, oh, good luck. Basically, you cannot, you don't want to over-dilute, but at the same time, you don't want to be overly optimistic because things change. Again, markets change. The market has gone down 10% over the past, 48 hours. So sentiment changes very quickly. The meta might change. You might think if you're doing an AVS, you can raise at a high valuation. 3 months from now, 6 months from now, there might be a new thing. And then people are like, I'm not, all of a sudden AVS comps are down. It could be the technology changes. There's some breakthrough that all of a sudden renders yours less relevant than it was before. And customer demand changes. So again, always raise with a margin of safety. Don't assume that, down to the week or down to the sprint, I'm able to plan and get all the stuff I need done. Always build it in. Okay, fourth, incredibly important. As a founder, probably one of the hardest jobs for you is to find and do the one thing that matters. If you're a founder here and you say, hey, what is the one thing that if I do this, my company is almost guaranteed to succeed? Your goal is to actually figure out how do I do that thing and exclude all the other noise that exists in the business. So too often we find teams.
I didn't get that. Could you try again?
No, I think it was great. It's like they too often do. They don't focus on the one thing that matters, and they do all this other shit that actually doesn't matter at the end of the day. Let me give you a couple examples. We have a team. They have about a year left of runway. They're going to be raising in January. They have a beautiful, beautiful roadmap for Q4. Lots of different features there, okay? But if you're a team that has done a seed and you're doing a Series A, what does a Series A investor look for? It's not additional features on the roadmap. It's customers. It's growth. It's AUM. It's revenue. And so this team delivered us this beautiful roadmap, and I told them nothing matters. This roadmap does not matter at all. In fact, you should throw it out. The only thing that matters for your business to be able to raise in 3 months is to get revenue, get customers, and get AUM. So again, if you find yourself focusing on features instead of growing the number of users on your product, you likely aren't focusing on the one thing that matters. Second example, teams that focus on tech debt instead of shipping. Again, I was a PM. I worked with engineering teams. I was an engineer before that. I understand how tech debt can slow things down. I totally get it. But you all didn't sign up to work at a big enterprise where you have the luxury of time. You might have 1 year of runway, 2 years of runway max. So you really need to be, if you spend 2 months or 3 months refactoring your back end, well, that's 3 months of time that you're not actually growing your product, getting customers out there, building the features they might need to land new customers. So if you find yourself too much focusing on tech debt and not on shipping new features, you're probably not focusing on the one thing that matters. Third example, teams that focus on being too broad and not being deep and experts at one thing. So again, if you're trying to find product market fit, there's value in bringing on different customers with a specific goal of testing hypotheses, but your goal should be to kill those customers over time that aren't part of your product market fit. We find teams sometimes doing 3 or 4 or 5 different things, and the product offering is different for each customer. And I'm like, there's no scalable business here. And we'll talk about product market fit soon, but if you find that you're going too broad and you're not focusing on the one thing, the one set of features that's going to drive the business, you're probably not doing the one thing that matters. Okay? Spend a lot of time here, but it's incredibly important to find and do the one thing that matters. How do you overcome this? Make sure you align with your team. What is the one thing that will basically guarantee success? The flip side of this, you can also ask, what is the one thing if I don't do this, I'm guaranteed to fail? Both ways are helpful in thinking about the problem. And once you figure out what that one thing is, okay, get your team to realize it's the one thing. And this might mean, by the way, your engineers aren't just shipping features. It might mean they're augmenting their capabilities to focus on the one thing. But arguably, that's more important than you trying to manage too many different things simultaneously. People have limited focus, and it's amazing when you get everyone aligned on one mission, how effective it can be. And after that, just don't plan for it, just do it. Don't write a plan, just go ahead and do the one thing. Okay. Hire slowly, fire quickly. I understand as a founder, you get capital, you're like, I need to grow the team. And you feel strong pressure from your customers, from your investors, from others to grow the team. And the challenge here is if you go too quickly and don't bring on the right people, you do more damage than if you just never hired that person in the first place. Ask any founder, experienced founder this, they will 100% agree with that statement. So people think about, okay, well, I own, as a founder, X% of the company. I'm going to bring on this person. They might have 0.5% of the company. But that might be on the cap table, but that's not in the day-to-day ability for the company to succeed. If you bring on an 8th person in your company, they are 12.5% of your company. The cap table might say otherwise, but they're over 10% of your company. And could you imagine if you had a car or you had something else and 10% of it wasn't working well? You'd be like, well, shit, I got to fix this. Like, this isn't okay. But too often, people lower the bar for additional people, and all of a sudden, a large percentage of their company is not being operated by A players. I think Steve Jobs had a really great way of saying this. A players hire A players, but B players hire C players, right? And crypto talent is very competitive. If you have a top 1%, 10% engineer, it is very hard to get those engineers. They want to work at a place where they're challenged, where they're motivated, and there's no dead weight, right? And so as a company, you need to make sure that you don't have any dead weight because it's going to hurt your ability to actually scale the company over the long term, even though in the short term it might be great. I got a head, I can now, the head is, the role is filled, and I can now move on to the next thing. So just be really, really careful. Lastly, if you hire, if you do make the wrong hire, you definitely need to fire quickly. I've never met somebody, either in dating or in running a company, that says, man, you know what? I wish I waited longer to fire that person. Like, once you know, you know. So be really conscious of that. Revolving doors are bad, so you don't want to keep in this loop of hiring, figure out the wrong person and fire. You want to make sure you take your time and hire the right person. Okay, lastly, on the company building side, get out of stealth. I cannot tell you the amount of times teams stay in stealth, and I have zero understanding as to why. The risk of irrelevance is much, 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 much greater than the risk of somebody finding your idea and copying and beating you to market, right? If you're, think about it, if you have 2 years of runway and you spend a year of that in stealth, that is a year, 50% of your time that you're not doing the things that are required to actually build a business. If you're in stealth, you aren't learning and iterating. You're not talking to customers, you're not advertising your product, you're not getting feedback, you're not shipping. you're not able to build excitement. If you're in stealth, how are you going to get people excited if you can't talk about what you're building? You can't. You have no momentum at launch. So again, we see teams, great, we're going to be in stealth, and then we're going to launch and assume that everyone's just going to love our product. And that never happens, almost never happens. You have no momentum that day one. You also don't lead yourself as the market anchor. I think we all know this is the case, that when I say DeFi Monad, there's a certain team that comes to people's mind. Or if I say, wallet Solana, there's a certain thing that comes to people's mind. And you have the opportunity, there's a very narrow opportunity sometimes to define yourself as being that anchor in the market upon which everyone else is measured. And if you're in stealth, you're not able to anchor yourself as that one thing. And lastly, again, we talked about this, you have limited runway. You don't want to spend 50% of your time not actually doing the things around building a business. So who did this well? Well, I think we're all here right now. Say Monad did a really good job, right? I mean, the product isn't in mainnet yet, but there's hundreds and thousands of people around the world building globally, ready for this to go live. Could you imagine if Monad just said we're in stealth and didn't focus on community, and then day one we're going to have a success? That'd be silly. But for some reason, teams think when they do their own company, they need to stay in stealth, and it's kind of a silly idea to me. Jito and Solana did this really well. They very quickly established themselves as the MEV platform on Solana, and almost they went so big into this that if you're an investor and you wanted to fund somebody else that wasn't Jito, it was kind of like, oh man, it's going to be pretty hard to overcome that. Right? They're a great team, but they very quickly branded themselves here. They built in the open and did a fantastic job just landing an incredibly important primitive in the Solana ecosystem. Another one here, you might not be able to see it in full, but is Photo Finish. So this is a virtual horse racing game on Solana. They started by having an NFT mint, and then they launched another NFT mint where you can breed the studs and the fillies together to create new horses, and those new horses were used in the game. So they, over the course of the year, built out this game, but had their community engaged at every single point, such that when the game went live, everyone was super stoked for it. But could you imagine you launch the game and there's nobody there? I think that's too often what we see from founders, and it's really unfortunate that this happens. So again, your goal is to be doing plus EV, enterprise value activities to launch, building community. Sometimes if you're building a AAA game, it takes time to build. It takes 1 or 2, 3 years. But there might be things around mini games or other quests that you can be doing to keep your community engaged in the meantime. You can be going on podcasts and getting people psyched for how good this game is going to be. And just figuring out, once I get the MVP, how do I push that out as quickly as possible rather than trying to wait for the rightful product. Okay, those are the things on company building. Next is product. There's only 4 things in product building. But perhaps I'll pause here for, say, maybe 2 or 3 questions that come up, just so you're not trying to retain all those questions until the end. I don't know if we need a microphone or if people just shout out. I don't know if you have a point of view, Fitz. Okay, does anybody have a question? Just put your hand up and a mic will come over to you.
There's some run into this fella in the back here.
Yeah, hey, Nick from Squid. Would love to hear your thought process on balancing capturing market share versus capturing revenue.
I would say I mean, it depends on the type of business, but generally market share is more important in growing markets. For example, when we were we invest across ecosystems, but a lot of our focus has been on Solana. Historically, that's where we spend a lot of time. During the bear market, we saw a lot of teams that were category leaders that had a large amount of market share and were increasing market share during the bear market, but may not have been making a ton of revenue. So one of those examples was Helios, the large RPC provider on Solana. Another one was Squads, which is the default multi-sig platform on Solana. And so for both of those infrastructure companies, they knew if they charged a lot of revenue, their customers literally couldn't pay it. I mean, Solana was at $16, things were bad. So it wasn't about revenue, but it was about market share, and specifically increasing market share during these hard times. And then we invested in Helios, and they've 20x revenue over the past year as the market came back. Because now they have customers can pay because the prices are up, et cetera. So I would always bias towards market share. And then once you win those customers, being able to turn on revenue afterwards, then focusing on revenue. The one caveat I'll say is, and we're going to talk about this, don't assume you have product market fit if you aren't charging for your product. Like people think, oh, people love it. And then as soon as you go to charge for it, people are like, I don't need it that much. So like you need to make sure that people actually will pay for your product eventually, but generally bias towards market share.
Thanks.
All right, maybe one more. Wow, either I'm saying everything perfectly clear. Okay, another question here, yeah. One or two questions.
Normally, like people, like I think consensus that like 95% of startups die. Suppose you do that, everything you said perfectly on those 5, 6 points. After that, what do you think the probability of the chance that the company succeeds in your gut feeling?
Yeah, I mean, it's a great question. So the question just for the live stream, I guess, is, I guess a stat, 95% of startups die. If you do everything right, what's your chances of success? I don't know. I mean, crypto's hard. Like, we've seen teams that manage cash really well, that build a good product, but then like that chain that they spend a lot of time deploying on ends up not really getting that many customers. And if they built over here, they would have done better. I can't put a number on it, but I can guarantee if you don't do some of these things, you're definitely not going to be successful. All right, one final question, then we'll go on to part 2.
Yeah, hi. My question is in the EV enterprise value page, how do you value the value of tokens? And oftentimes in the VC community, there are also investors that's saying, listing, like true listing is more important than product. So, the one thing to get it right, in terms of listing successfully versus product successfully, because we do see quite a lot of tokens that they are able to list successfully without actually shipping any product.
Yeah, it's a great question. So I do laugh when I see teams launch their token before they launch their product. Like, to me, that becomes immediately clear what their priorities are. It's not actually building and creating value for users in the ecosystem. It's, I want to launch a token. And then there's this product that becomes the meta that helps me get there. So I think generally if a team is launching a token before they've launched a product, to us, we just tend to stay away from those. There's a very clear profile of founder we've seen over time. But by and large, I will say tokens are incredibly important to the success of your business. In fact, there are many companies, like I can tell you there's tokens that we wanted to buy because we really like the team. We wanted to buy more on the open market, but there's no liquidity for the token. And so I'm like, okay, well, I'd love to write $1, $2, $3 million into this token. But if there's no liquidity, if that founder hasn't prioritized liquidity on the open market, then I can't go ahead and buy that token. So if you don't have good liquidity around the token, you're actually not enabling price discovery, and you're not enabling other value-add investors to come in and increase their position over time. So I actually think it's incredibly important for founders, given that tokens are the way that protocols are decentralized and value is shared with the community. You definitely need to focus on the token, because if you don't, again, you can be a great product, but if you have a bad token launch and a bad token liquidity, it's going to be hard to sustain your treasury operations, over time, and keep the people excited about using the product. All right, we have a lot more time for questions at the end. That was really great interlude, just to be able to address some of these things. Let's go on. All right, so as founders, you need to be relentless about finding product market fit. Now again, people have all these crazy definitions for product market fit, and to me, they're way too confusing. The way I think about product market fit is find repeatable cases of hell yes customers. So again, find repeatable cases of hell yes customers. And why do I say this? Well, first is you need a product to serve a market. And if you have different products for every customer in that market, then you actually haven't built a product that's serving a market. You built a product that's serving one customer, right? So you actually need to figure out what is a repeatable way where I can offer the same product to many different customers in this defined market, and then earn market share within that market. Secondly is hell yes. So as a founder, if your sales calls are going something like, hey, this is what we do, it's a really cool product, I'd love for you to try it sometime, you're generally not selling the right way. Rather than pushing your product on customers, your goal is that customers pull your product. In other words, you're asking them, hey, these are the types of, tell me about how you do a certain operation, what types of problems you have, and then say, oh, I think we have a product that can help you with that. And it can reduce your efficiency by X and do Y. People are like, how do I get it? What do I have to do? Where do I sign up? Can we start today? If you find you're not getting a strong pull signal for your product, it probably means you don't have product market fit. So again, as a founder, the faster you can get to product market fit, the faster you can start to create those elements of enterprise value, whether it's revenue, whether it's market share, whether it's a certain set of customers that you're able to onboard that are meaningful in the industry. Really be thoughtful about trying to get to product market fit. It is one of the most important things to do as a founder. So how do you tell if you have product market fit? Well, there's a couple different ways, but here's two. One is if you apply prices and people still stay on the product. Again, this kind of goes back to the question from the Squid team, which was, yeah, it was a great product, but as soon as you start charging for it, people don't really need it. Okay, well, you actually don't have real product market fit. You have a product, but it doesn't fit a particular market with a particular set of needs. Or you go to raise prices. If you raise prices, do people still stay on the platform? That's generally a really, really good sign. I don't know if people have thought a lot about pricing, but I really like this approach to pricing that somebody told me. I don't know if it's in the YC manual or what, but it's basically double prices until somebody says no. Like people think, oh, I'm afraid to charge too much for my product. Like find a customer and charge them, and then find the next customer and double it. And what you find is that might be like, okay, great. And you go and double it again. And then eventually you'll hit a point where there's like, okay, this isn't going to work for us. But now you've actually found true price discovery for your product offering. I think too often founders actually undercharge for their products. And if they did charge, they'd be able to demonstrate more revenue and therefore more product market fit in many cases. Secondly, is our customers evangelizing your product. Like there's certain products we use that I'm like, man, I love this product and I just want to show people. Or when people have a similar problem, I'm like, yeah, we use this and it's really good. So always think about, are customers evangelizing your product? If not, you might not have product market fit. Okay, as a product manager, one of the things I've learned over many years is customers lie. And I know it because I've been on the receiving end of those lies, and there's times I've kind of lied just because it makes the conversation go easier. So customers lie. Do not ask customers what they want. Again, especially this is true with whether it's a DeFi product or whether it's like an infrastructure product, a SaaS product. If you ask customers what they want, they're not going to be able to articulate what they need. Right? And I think too often we as product managers, we're stuck here. We're like, oh, what do customers want? They said they want this, somebody else said they want this, and you're trying to integrate all these pieces together. And what you realize is once you build a product intuition, you just know what, you say, hey, what do I want? Like, what do I think this customer wants? What do I want? And that's actually a better product than what the customer asked for. Again, there's so many classic examples, whether it's the initial Ford Model T, whether it's the first iPod that came out. Customers would not have asked for these products, but those innovators understood the customer's needs, and they were able to build a product that matched that. So again, instead, ask customers, what do they do? Okay, well, if you want to trade meme coins, if you want to do this, what do you do today? How does it work? And through that process, ideally, you identify opportunities for you to build a better experience than exists today. And also ask them what they're trying to accomplish. Again, they might, to go from A to B, have to do a bunch of random stuff. If you can more directly get them from A to B, that might be a way that you start to create value for these customers. So again, don't ask customers what they want. They will lie. Lastly, I'd say on this is, too often I find PMs experimenting. And if you find that you're a seed stage company and you're running A/B tests, you're probably doing it wrong. Just to be 100% clear. Like if you're, a company like Google and you have, hundreds of millions of users or hundreds of thousands of users depending on the product, you have the time and energy to run A/B tests, and the implications of you being wrong can be dramatic in terms of the market share up or down that you might have. But you have really limited runway as a startup, and you kind of need to go all in and very fast because you don't have time to run complex experiments. So just make a decision and if it's wrong, you change it. But like the risk of taking too long is greater than the risk of just shipping a wrong product and having to correct it a week later. So just be really mindful about that. This is another reason why we as VCs put a premium on founder market fit. Because I know that if you've worked in a market, you understand the type of product that needs to be built, and you don't need to test a bunch of shit that if you just worked in the market for 5 years, you know immediately what the right answer is. So customers lie, don't ask them what they want. Okay, one of the most important things today is simplicity is more important than complexity. There's many people attributed to this first quote here. If I had more time, I would have written a shorter letter. It's Blaise Pascal, it was Mark Twain. We don't actually know the first one, but nonetheless, it is incredibly important. Anybody can design a product that lumps a bunch of crap in there, but to actually build a really, really good product, you need to strip away most things and create one or two compelling experiences that people engage with. Does anybody know who said this one? Make the requirements less dumb? Elon Musk, exactly. His 5-step process of product design, first thing is make the requirements less dumb. So too often, you're going to ask customers, what do you need to do? And they're going to list a long list of things, this is what I need to do. And your job is to figure out, you actually don't need to do all these things. I bet if I deliver these 3 requirements, you'll be able to get the same experience or get 99% of the way there. So make the requirements less dumb. Anybody know who said this one? Do one thing uniquely well. Okay, this is Peter Thiel in 0 to 1. Okay, do one thing uniquely well, and to do that, you oftentimes only need a simple product, not a complex product. So, okay, really important. Why? What are the problems if you don't have a simple product? Well, one, customer attention span is decreasing. There's times people show me an app, like I'm getting drinks somewhere. They know I'm an investor. Like they pull out their app, and they show me like 5 or 6 different user experiences on the app. And I'm like lost. I'm like, what's the point here? I can't do all these. No customer is actually going to go through all this. People have such limited attention spans already, and it's just getting shorter, that your product has very, very limited time to actually make an impact to those customers. Secondly, as a team, you're accruing technical debt. So again, what happens is teams end up adding features, but how quickly do teams remove features? Probably not very often. And so now your poor engineers are like trying to maintain all these features that all of a sudden are conflicting with each other instead of saying, you know what, we need a simple product. If this is more important, great, what are we going to cut? Always be thinking about how do I drive a simple product and cut things, even sometimes cutting off customers if they're not the right customers. Third, if you have a lot of stuff in your app, it's unclear the value proposition of your app. Again, you should have a product and it's like, what is the one thing this is good for? Cool. I mean, think about Uber today. There's like a single call to action, which is book a car. Now, again, they have food, they have groceries, they have all sorts of stuff. At the end of the day, the single call to action is very clear in that app. So what is the value proposition? You have to be really clear on that. And simplicity drives clarity around your value proposition. And lastly, you're serving too many customers if your product is complex. You got to cut customers. You got to keep a really simple product that works. Okay, so how do you tell if your product is too complex? One is, can you describe your value proposition in 2 sentences? If I go out there and grab a drink and you come up to me and say, hey, this is what we're building and this is the value proposition, if it takes longer than 15 seconds, it's probably not simple enough, right? So be thinking about what is the value proposition? How do I simplify this into 2 sentences? Second, especially if there's a B2C product, can customers have a delight moment in 60 seconds? In other words, if I onboard to the app, am I going to have a great experience or that aha moment in 60 seconds? If the answer is not, too long. If I need to go KYC a bunch of things, do this and that, you've lost it. You need a simple product that's going to get a good experience in 60 seconds or less. Third, I mentioned this, but is there a singular call to action above all others? Is there one clear thing that's important to do in the app? If not, it's probably too complex. And we talk about this, do you keep adding features but never deleting? So always build simple products over complex. It will allow you to communicate clearly what is your value proposition, and it's going to allow customers to more easily digest and onboard to your product. All right, last thing on the product side, and actually the presentation. Referral codes. We in crypto love referral codes. What's the code? What's the code? How do I get a code, right? That's like the common thing. But too often, I think people miss a valuable opportunity in referral codes. The referral code should not be a code. Like, what is the value in getting a 6-digit alphanumeric string? Instead, when you onboard people, how do you actually get them to use that core product experience quickly? And let me give you an example. One of the companies we invested in is Pay. It's basically a private crypto Venmo. So you can pay people and it's totally private. Well, when they started to go live initially and get their first 2,000 users, they said the only way to onboard in the app is to get somebody to pay you. And it sounds simple, but it actually created a much better product experience, end user experience for the customers. And here's why. Imagine I go download this app Pay and I show up and I look at 0 balance. Well, what can you do with 0 balance? Nothing. You can't do anything. It's just sitting there and you're like, okay, I can't do anything. But if somebody pays me, I now have money. Now I can say, oh, I can send that to somebody. Oh, now I can claim points because I have money in there. Oh, now I can interact with DeFi because I got money in there. And so the very act of saying, hey, somebody to onboard you needs to pay you, all of a sudden unlocked the value proposition of the app in a way that if I just got the app and had 0 balance, it wouldn't. So I think that was a really good way in making sure the value proposition was part of the referral rather than just giving customers a screen that they then needed to figure out what to do. So I think here's another couple examples that did this well. X back in the day, Meta back in the day. You can imagine if you're building a betting app, like what would be really cool in a betting app is instead of just, hey, you got onto this crypto betting or the sports betting app, what if in order to get on, somebody needed to send you a bet? Like, hey, you're going to join me in this bet. You want to join me in this bet? Cool. Now we're like in this bet together on this application. That is a much more compelling onboarding experience than just, oh, well, here's a betting app, and all of a sudden you now look at 1,000 bets you can make, and you're overwhelmed, and you kind of put the app away. It's kind of how I feel every time I open up FanDuel. Versus like, oh, somebody sends me a bet, and then we're in this together. That's a much better experience. Okay, referrals should be included in the core value proposition as you should include the core value proposition. So in summary, pick the right co-founder, optimize for a massive financial outcome, create enterprise value with your capital, always be mindful of that, do the one thing that matters, hire slowly, fire quickly, get out of stealth, please God, get out of stealth, be relentless about finding product market fit, remember that customers lie, you also might find yourself lying in the future, simplicity is always better than complexity, and referrals should include the core value proposition. So that's a summary, the 10 things for product and company building. This is our website, sixman.ventures. You can reach me on Telegram here. Thanks for the time. Let's go take some questions, and after that, I'll be hanging around for a bit to go get some drinks afterwards. Thanks for your time. All right, we do have a microphone. Looks like we have a first question here, and then a second question here.
Thanks for the presentation. My question is about the market share. So the crypto ecosystem has evolved around airdrops.
Yep.
So we have airdrop farmers.
Yeah.
So how do you sustain your market share after the token launch?
It's a great question. So generally, we actually did a piece on this. We published a piece. We looked at 2 million airdrops and tried to understand how people's behaviors changed. At the end of the day, I'm trying to think back, it was a while ago, the two main insights, one were focus your airdrop to people who've used the product. I think sometimes people use an airdrop as an acquisition tool. So imagine you've interacted with some other product. Well, I'm going to airdrop you, and now I'm going to vampire attack in this way. And what we found in looking at all these data points is that doesn't really work for most companies. So instead, only airdrop to core customers of the product. And then secondly is do a smaller percentage of your airdrop and not like 10 to 15%. And the reason is you actually want to be able to use that treasury over time to engage customers in new ways or as you grow your customer base, rather than, I think too many teams do too large an airdrop, make a bunch of people rich, and then they go on to the next thing. So at the end of the day, your product should be good enough that you don't need an airdrop. Or if you do use an airdrop, you're using it for a very specific reason to test the platform at scale. So for example, if you're building an infrastructure product, you might need to make sure you can handle like hundreds of thousands of transactions a second. And so by using the airdrop to incentivize customers, you're now creating a whole lot more volume that allows you to test, are things working properly? Or if you're building a cross-chain bridging solution, by doing the airdrop, you can now incentivize certain routes and certain blockchains and get for example, one EVM to another EVM, Solana to this, et cetera. But you're not doing it across any trade. You're doing it against very specific new launches to test and make sure they're working properly and to help get customers even just aware that they can use this new route. So at the end of the day, your product needs to be good enough that the airdrop isn't the only reason people use it, but airdrops can help drive specific behaviors that test your product and make sure people are aware of the new things that you launch and add.
Thanks so much.
Thank you so much for all of that. My name is Brian from Rarebet Sports. There were so many great nuggets in here that I wanted to re-review. Will you host this deck anywhere? I know it was filmed, but
Yeah, I think it is going to go on some sort of YouTube channel or something else. I'm happy to share it as well, but I do think it will get posted somewhere.
we
So
have
stay
a
tuned.
TG group with 6-man, although you're like the only one not in it. So
What are you saying?
we put a photo of you in there, and everyone was having a good time.
Okay, great.
The second thing was, could you expand just briefly on founder market fit?
Yeah. Look, I think you don't, I guess depending on the type of, it depends on more on some markets than others. If you're building a sports betting product, for example, having experience in the sports industry is incredibly helpful. Because if you're trying to make the other sides of these sports books, understanding that process and who are the main market makers is very valuable versus trying to learn all of this industry knowledge from day one. In terms of getting licensures that you might need for a sports betting process, there's a very specific set of regulators, such as Isle of Man, that you may not know or have the right connections to if you haven't come from that world. So another one is DeFi, like somebody who's actually worked in the liquidity business before is just going to have much better connections and be able to get initial bootstrap liquidity on their platform than somebody who doesn't have it.
Okay.
So again, it's not saying that you shouldn't. If you're passionate about something, go build it and find founders and people that help fill out skill sets you don't have. But if it's at the end of the day, I have a choice to invest in something where somebody does come from that industry and has a really strong thesis or doesn't, like this one is always going to be able to develop, demand a higher valuation and likely more investor attention.
Sure, makes sense. Thank you.
Yeah. Okay, back here or over here.
Thanks. How's it going? I think it was point number 8. You said customers lie.
Yeah.
I was just curious if you could maybe share a few common lies that you've come across. It feels like a very gut feel sort of problem to handle. So I'm just curious, are there any common lies that you've encountered?
I think an example one is customers saying, hey, if you're an infrastructure provider, we need you to add this new blockchain in order to keep using it as a customer, or else we're going to switch to someone else. I've been on the other side of that before, and very often we're like, hey, we can't add this, and here's why. But our product and service is so much better than any of the competitors that they actually don't leave us. They just try to use that as a leverage point to try to get us to add a new blockchain or add a new product. So it could be, again, feature expansion. The customer might say, hey, if you launch this, we're going to use it. Another one is when I was at Paxos, we initially only offered Bitcoin, Bitcoin Cash, Ethereum, and ETH Classic, I think, on trading. And the reason for that was securities related. But we took a bunch of our customers like, hey, we want to trade Aave, we want to trade all these other things for our customers. And we're like, great, now we need to go ahead and do a really big process to review these, make sure we have a good securities understanding and launch these in a compliant way. And we did that, and those 4 tokens we added, I think it was Aave, Chainlink, maybe 2, what were the others? Maybe Compound and one other. And their percentage of trading volume was minuscule. It was less than 1%. So we did all this time, all this energy. Customers said they want these tokens, and we launched it, and there really wasn't much trading volume. So those are 2 examples on how customers lie in terms of what they want, but then they actually don't really follow through on it.
Thank you. Appreciate it.
Yeah.
Hi, Kyle. Hi. Yeah, my question is, oftentimes we see projects having 4 to 5% or even more for advisory tokens,
Yeah.
and also some of the VCs also, brand themselves as providing advisory service around VC introduction, go-to-market strategy, tokenomics design. So, what's your take on that? And advice to teams that's evaluating advisors.
Yeah, I think you need to have a really, so there's some VCs that have a view that you should not have any advisory tokens. If you need somebody, then they should pay to be part of have the privilege to be part of your cap table. There's zero space for advisors that just receive without putting any sort of risk capital in on their own. That's one view. We've had teams that have advisors, but it's very specific. Hey, this is what I need from you at some sort of cadence. And if that advisor doesn't meet those obligations, then they don't vest the rest of their advisory shares. So I do think advisors, again, especially if you're in the gaming industry, this one company was, like they needed access to certain game studios. And so they had an advisor that helped introduce them to a number of really important people that advisor was already like rich, didn't like need to pay money to be part of it, but they really liked it. And by bringing them on board, they got the right introductions that they needed. So I do think it's helpful to have advisors. If they pay and become angel investors, that's even better. But 4 to 5% sounds really high. Like if you think about it, if you give 5% of your business away for advisor shares, like that might be the equivalent of $2 million, depending on the certain valuation, right? 5% of $2 million, like was it $20 million? Like that valuation, that is a lot of money. And if you said, hey, you'd rather have advisors for 4 or 5% versus another $2 million, to most founders, having that much more runway is way more helpful than a couple of people that are advisors that might respond to a couple of emails. So generally, I tend to stay away from advisors, but there might be specific tactical cases where it's useful. 5% sounds high. In the back. All right, so we'll go here and then there. Oh, sorry, it was here and then there.
Just wanted to ask about the enterprise value activities. What are the patterns that you see in different teams? When do they start working on these activities before, like prior launch? And then how do those look like after the launch? Because I feel like after the launch, like it looks like there's not enough importance around these activities. So what's the difference between those patterns before the launch and after the launch for adding more enterprise value?
I think you need to be thinking about it before you launch and after you launch, like the entire time. So as an example, you launch a product, cool. How do you establish, for example, exclusive distribution partnerships for a particular company? Like you can be thinking about that before you launch your product, and ideally after you launch your product, you're trying to figure out how do I get some of those key logos, for example, to be part of my product. That's always a thing where if you have an infrastructure provider and they show, I don't know, like the biggest companies, Phantom Wallet or Magic Eden or someone else, it's like, oh, well now they're trusted and evaluated by real customers that actually have money and can pay for things. So I think it's just a mindset. Like at the end of the day, a product itself is not going to be successful. It's a product in the wrapper of a talented team and company that is focused on delivering value to themselves and the ecosystem and shareholders. Like that's the actual, it's like everything you do around the product is wrapped around by this company and the ability to create enterprise value. It's hard for me to like distinguish them too much. But again, lots of teams build great products and they fail because they run out of cash or something else happens. Lots of mediocre products, these companies are huge and they just keep growing. All right, question over here.
Thanks for a great talk. I was curious to hear your thoughts on bootstrapping and also raising. There's first-time founders, second, and so on. I feel like there's a lot of value in bootstrapping, especially in early stage, going through IDMAs. So I'm curious to understand when founders should actually raise, especially let's say if they make some revenue early on.
Yeah.
Should that be a sign that they should be doubling down on onboarding strategic partners?
Yeah, I think you should bootstrap almost as long as you can. But once you get a sense of, and again, some teams can't. Some teams are like, hey, I've got a family at home. I can't just bootstrap for 6 months. They have other obligations. And it's like, great, well then go raise capital and find that right set of partners to make you successful. But you should be bootstrapping almost as long as possible because it means that you're going to be able to dilute less of your business over time. And you essentially go right to a seed round or right to a Series A type round. Now, where that can get in trouble is in 2 different areas, at least 2, there might be more. One is an investor can help you get some of those connections that you wouldn't be able to get otherwise. So for example, I don't know, if you're building a DeFi protocol, I'm just making this up, DeFi protocol, investors might know huge KOL syndicates and can like evangelize, hey, we're investors, we diligence this company as a KOL, like you should join this. Like having that check of an external, like respected capital allocator, evaluate you, and then get the connections. That can help accelerate your business more than if you just kind of kept trying to plod along on your own. So whether you need certain connections or you just need more capital once you start to see product market fit. Like if you find you're growing at this pace, but then somebody has capital and is just able to grow like this much faster, you might lose even if you were the first one to the market. So I think what I'd say is, again, stepping back, bootstrapping is great. We encourage founders to like delay taking on capital, generally until they like really start to prove out things around the product and the thesis. But getting capital is the right time when it helps you scale more quickly once you figure out what's working. And secondly, if you need certain connections or advice that you feel like will help accelerate your business than if you went at it alone. Those are two, hopefully that's helpful, yeah. Cool, well I think that's pretty much it. Again, thank you so much for listening. I'll be hanging around for a while afterwards. Feel free to come up to me and say hi. Enjoy the rest of your time here. Again, it's a really exciting community. I'm excited to be part of the Monad community. I'm an angel investor Monad, and I look forward to building alongside all of you over the next couple of years.